Welcome back to the Strategy Sessions, the podcast dedicated to helping you move from market spectator to confident, disciplined strategist. I'm your host, Yana Curry, and today we're tackling an emotional challenge that stops more traders than any bad strategy ever could: the paralyzing fear of loss.
It's a universal feeling, isn't it? That sharp pang of anxiety right before you click buy or sell. It's a shiver that runs down your spine, and it's the difference between executing a perfect plan and freezing up entirely.
Exactly. That fear is what we're dissecting today, and more importantly, how to eliminate it, or at least master it before you commit a single real euro or dollar. Joining me to navigate the psychological and strategic battlefield is guest's name, a seasoned financial strategist who's advised everyone from institutional investors to retail traders. Guest's name, welcome to the show.
Thanks for having me, Yana. I'm genuinely excited about this topic because it's the non-glamorous foundational work that separates the players from the professionals.
Context: why this topic matters now.
Well, the market has never been more accessible, which is fantastic, but it's also never been more prone to impulse. Most new market participants commit this cardinal error. They jump straight into the real money pool without learning to swim first. They've read the books, they've watched the tutorials, but when their hard-earned capital is on the line, that theoretical knowledge dissolves into panic. The result is almost always a painful, quick, and discouraging loss.
So it's the lack of translation from theory to real-world pressure that sinks them.
Precisely. And that's why we need a sophisticated laboratory, an elite training camp, if you will, where you can practice, fail, and perfect your strategy without risking a single penny. This isn't a fantasy, it's what every expert recommends: the demo account or the financial simulator.
Core discussion: the simulator as a high-level laboratory. I love that analogy. An elite training camp. Walk us through that, guest's name. What is a trading simulator at a high level?
Think of it this way. Would you fly in a Boeing 747 with a pilot who has only ever read the flight manuals?
Absolutely not. That's absurd.
It is, and yet that's what most people do in trading. The financial simulator is your personal high-fidelity flight simulator in the turbulent skies of the market. It's an exact replica of the broker's platform, but it operates with virtual money. Crucially, you're accessing real-time market data. You can execute orders, set stop-loss and take profit levels, and experiment with leverage, all without any real consequences.
The key element the document stresses is experience. E. How does a demo account provide a superior form of experience compared to just observing the market?
Because you're not just reading about volatility, you are feeling it in real time. You observe how a jobs report or a statement from the Federal Reserve instantly moves your charts and impacts your simulated position. This hands-on, real-time exposure develops what we call technical expertise, E.
Can you give us a concrete example of that technical expertise?
Sure. Imagine high-impact economic news dropping. A novice seeing the sudden, wild swings on the chart might freeze, panic, or execute an impulsive trade. The demo experienced trader, however, has already rehearsed this reaction dozens of times. They know where the emergency close button is. They know the optimal distance for their stop loss, and they can react in milliseconds. This skill is pure technical muscle memory, and you only acquire it through deliberate, controlled repetition.
That's a powerful point. But here's the major criticism I hear about demo accounts. People don't take them seriously. They treat the virtual money like monopoly cash. If you don't take the simulation seriously, are you actually losing half the formative value of the training?
Absolutely you are. And that brings us directly to the concept of risk, because you can't master something you haven't measured seriously. The value of your simulation is directly tied to the seriousness of your commitment. You have to treat that virtual capital like the real thing. Otherwise, all the technical skills you build are built on sand.
Understanding and measuring risk. Let's transition to risk. The document uses a great metaphor: Risk in trading is like the wind in a sailboat. You can't eliminate it, but you have to know how to measure it and use it to your advantage. What are the key points of risk we should be measuring in the demo?
The wind analogy is perfect, Yana. Risk is simply the probability that your investment's actual return will be different and usually worse than expected. We have three main types to measure in the demo. Volatility. This is the strength of the wind. How much does the asset move over time? The demo account lets you measure the historical volatility of your chosen assets, be they stocks, commodities, or currency pairs, before you risk real capital.
The position risk. This is how much sale you put up. Experts always stress, never risk more than 1 to 2% of your total capital per trade. You must simulate this rigorous risk management in your demo. If you define your virtual capital as euro 5,000 and your rule is 1%, you must practice closing that position the moment you hit a euro 50 loss. Practice that 100 times until it's unbreakable. This forces the discipline.
Leverage risk is the double-edged sword. Leverage is like using a mechanical shovel. You can move a lot of dirt, generating huge profits quickly, but one wrong move can collapse the entire site. The demo is the only safe place to truly understand how much leverage amplifies both your gains and your losses. You need to practice responsible leverage use, simulating the real regulatory limits you'll face.
That transition from a percentage rule to a real concrete euro or dollar amount seems vital for grounding the discipline.
It is. It's what makes the virtual real. The simulator isn't just a place to practice button clicks, it's a powerful statistical analysis tool. This is where we separate the player from the strategist.
Advanced risk measurement, testing, and professional metrics. Let's discuss that strategist level. The document mentions back testing and forward testing. How do these work together, and why does the demo account excel at forward testing?
Backtesting is done before the demo. You take your trading idea, say, buy whenever these two moving averages cross, and you apply it to 5 years of historical data to see how it would have performed. That gives you confidence in the idea.
But the market changes. What worked in 2020 might not work in the current inflationary environment.
Precisely, and that's where forward testing in the demo account shines. It validates the strategy with current data and under real market conditions. It's the acid test that ensures your system isn't obsolete due to new geopolitical tensions or Fed rate hikes. It validates your real-time expertise.
And once you have these results, the professional language comes into play. You mentioned measuring with authority, using metrics like maximum drawdown and Sharpe ratio. Can you quickly explain those for our listeners?
Of course, to operate with authority, you must speak the language of professional risk managers. Maximum drawdown. This is the largest percentage loss your account suffers from a peak to a trough. Measuring this virtually gives you a real figure for your historical worst-case scenario. If your maximum drawdown in the demo is 15%, you know you must be mentally and financially prepared for a 15% loss in the real account. It defines your psychological breaking point before it happens.
Sharpe ratio. This is the king of metrics. It tells you whether your profits you're making are a fair reward for the risk you're taking. It measures risk-adjusted returns. A high Sharpe ratio means your strategy is efficient. If your demo portfolio has a low Sharpe ratio, it's a red flag. Your strategy needs a serious overhaul before going live.
So, it's not enough just to be profitable in the demo. You must be efficiently profitable.
Exactly. And the practical authority tip here is to document at least 50 trades in a spreadsheet, recording the asset, the result, the risk, and most importantly, the why behind your entry and exit. This statistical record is the foundation of the strategist. That's a perfect place to pause, guest's name. When we come back for part 2, we're going to dive into the most critical element, psychology. How do you bridge the emotional gap when no real money is at stake? And how does the trading journal become the pillar of trust, T? Stick with us. We'll be right back.